When you hear people talk about alternative investments or endowment-style investing, what does that mean? Well, in the most general sense, alternative investments are building blocks and methods that, at least at the time, most others aren't using yet. But beginning especially in the early 1990s, various large university endowments began shifting more and more of their portfolios away from the conventional mix of stocks and bonds into much lesser used building blocks and strategies of investment. The most heralded was Yale University's endowment, helmed for 36 years until he passed away just last month by the legendary David Swensen. In their June 2020 report, that endowment outlined their target allocation for the coming year. That included devoting nearly a quarter to absolute return strategies, nearly another quarter to venture capital, nearly another sixth to leveraged buyouts, and nearly another seventh to real estate and natural resources of various kinds. Note that only about 1/5 was reserved for publicly traded stocks, bonds, and cash, and the majority of that was earmarked for stocks outside of the U.S., with only 2.25% for U.S. stocks. Wow, what a contrast with the portfolios that we normally see, and I bet with yours too. So why would these endowments do this? Well, in the same 2020 report I mentioned, Yale gives their reason. They say the heavy allocation to non-traditional asset classes stems from their return potential and diversifying power. So in today's episode, we ask whether endowment-style investing using similar alternative investments might make sense for a portion of regular investors' portfolios, including yours. We discuss what such alternative strategies are, the various categories of them today, and we give some examples. We discuss why someone might consider incorporating them or, for that matter, deliberately leaving them out. We also discuss the risks with special attention to the illiquid nature of many such investments and how to partially mitigate these risks. The costs, including some of the hidden costs and how to partially limit these. How to set more reasonable expectations for how alternative investments may behave, how they may perform, and how long they might persist before offering an exit, and who, according to the federal government, may or may not invest in some of these investments depending on their income or investable assets. So stick with us as we discuss all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson and Erik Olson. Looking forward to another episode that we've got today. I'm excited about it. Erik, how was your week last week?
Well, it was a great week, but I have to say it's been a whirlwind. I was at a wedding in Denver, which is unbelievable, and then had to come back to the Midwest to really high humidity again. So I don't know. I can see why people enjoy Denver.
How was the wedding, by the way?
That was awesome. They took the chance of setting that back in, I don't know, January or February, or even actually last November, I think it was, when they thought, it's a little iffy if in May it's going to be open again. But sure enough, just in time, the skies cleared and the masks came off, and for at least for fully vaccinated people, and so it was fantastic.
Yeah, I had a similar experience. I went to a wedding this weekend as well, first time since before the pandemic, and it was great to see people and be around other people. No masks. So yeah, it was nice.
Yeah, fantastic.
Yeah.
Adrian, how about you?
Last week was a good week. It was my birthday week, so that was it was a really great time. It was a lot of fun just spending time with family and friends, just going places. I always say my birthday, June 1st, is kind of always like the kickoff to like my summer. So that was always it was a really great week. A lot of good memories, a lot of great memories, funny memories, happy ones. it was a great time.
Good
I wish
for
you
you.
two could have joined me.
Yeah, next time maybe. Who knows? Maybe we can schedule something in DC for Big 26.
The way you describe it sounds like my entire pandemic year you enjoyed in a week.
Yeah, I tried to. I guess some cool memories were I kicked some like field goals with a buddy of mine. I have like this like huge soccer field that's got like these football goal posts. So that was fun. We did that at like midnight. We rented a hot pink party bus to go to a winery. That was that's kind of just been in the back of my mind this whole week. That was a good time. So if anybody saw a hot pink party bus on the road last week, that was probably me and some of my friends.
So, Adrian, was that on your bucket list to go to a winery in a hot pink party bus?
Yeah, it was. I can definitely check that off. It was a really nice winery out in Leesburg. I liked it a lot. They had these like wine slushies that I had that were really good. And then we went to a brewery after, but I was kind of disappointed by the drinks that they had there. They actually weren't really good at all, but it was a fun time.
Yeah, it sounds like like I said, it sounds like a great time, and a whole year in a week you squeezed in. I need my birthday is in July. I'm going to ask you to plan it for me.
I'm kind of over just planning birthdays because I'd say from like March up until like the end of June, it's just like me and my friends, my families have like all these birthdays. I'll be pretty run down. If I plan at Roshan, it won't be that. It'd be pretty sad. So you should kind of delegate that to somebody else.
Field goals at midnight in a hot pink party bus is definitely a lot more than I expect to be doing. I'll be laying out at a pool. That's probably as far as it'll get.
Oh, that'd be awesome.
Yeah. So let's talk about today. Today we're talking about alternative investments.
Mm-hmm.
So Adrian, why don't you kick us off?
Yeah, I'll kick us off. It's another exciting topic we got here, and we're going to kind of give like a little bit of a broad overview for our listeners so you can come out of this podcast with a little bit of a better understanding of what alternative investments are. I'll kind of go over like a quick little synopsis of it, and then we can really dive deeply into it. And for its name, alternative investments, it's alternative to stocks and bonds. It's kind of really its own asset class. And there are a lot of things that make different alternative investments different from other ones. Some of the characteristics of alternative investments is they tend to have low correlations with traditional financial investments like stocks and bonds. To determine a current market valuation, it's sometimes very difficult for alternative investments compared to a stock where you're constantly seeing the price move up and down throughout the day. Alternative investments are a little bit different when it comes to evaluating their price, so that's something investors should consider. Some alternative investments tend to be sometimes very illiquid. That means you can't really trade it often. When you invest your money into it, it's going to be kind of maybe locked in for a certain period where it's not like going back to a stock example, it can't be traded constantly throughout an exchange. Another thing to consider about alternative investments is the purchase price. Normally, sometimes you have to invest a certain amount to get certain shares. That's also a big feature. And also, there's not really, for some alternative investments, there's not sometimes a lot of data or historical data when it comes to risk and return. Mm-hmm. So you do have to do a lot of research and due diligence when you're looking into alternative investment. And it is going to be different for everybody depending on what your age, your risk tolerance, your liquidity needs. But alternative investments are a good way to diversify when you're looking at an investment strategy where, say, you are heavily invested in stocks and bonds and cash. Alternative investments could be another piece to your overall portfolio to help you diversify, to help you have good performance if your stocks and bonds and cash aren't really doing anything to you. It's kind of another avenue investors look into to kind of really diversify and get the performance that they need.
Yeah, that's a lot of information there, Adrian. I want to start with just some pieces, and hopefully we can expand on it and break it down. But the first piece you mentioned that I thought was worth digging a little deeper into was you had mentioned alternative investments are investments that are not stocks, bonds, and cash. And so I know speaking to some people, the very moment we say it's not a stock, a bond, or a cash, or cash, they will just wonder what it is, right? So if we're talking about alternative investments and what they are, if I'm an investor and you tell me you have an investment for me, it's not stock, bond, or cash, what is it? Erik, I'll give that question to you.
Well, the definition of an alternative is, to a certain extent, just on the basis of what you just indicated, something of a floating definition. Because as something becomes more routine and incorporated into a normal portfolio, it's no longer considered an alternative. So once upon a time, when people would think, well, a portfolio might be constructed of large U.S. stocks and some high-grade corporates. Wow, if you introduced small-cap stocks, or you introduced international, or you introduced high-yield bonds, then you were talking in those terms, at least. It was like suggesting an alternative investment. So I think what we've done is, by virtue of the fact that you have identified it as it's not stock, it's not bond, and it's not cash, that sort of says we've laid to rest the question of how well one ought to be diversified within the stock world and within bond world, and now we're into other things. So big categories, I'd say, include things like not just the things, which would be asset classes, but also the ways in which you invest, which would be, I would say, are more strategies. But let's focus on the ways, or pardon me, on the things for a little bit. And we can just do these maybe popcorn. So I would say the first place my thinking goes about this is real estate and commodities. And within the commodities complex, you've got agricultural commodities, you've got energy commodities, you've got industrial metal commodities, you've got precious metals and so forth. And then real estate is a huge world too. How about you guys?
Well, I mean, another one that comes to mind that I'm sure people have heard of are collectibles. I recently attended a presentation where they were talking about the merits of investing in art and wine, right? So that's something where, and being a data person, I started looking at numbers, and the numbers were actually really compelling on both. More so for me, I thought the wine side was more interesting, assuming that the investors don't drink away any of their profits.
I'm trying to recall it, Roshan, but didn't you say there's like this wine alternative investment that pays your like dividend and like sending you barrels of wine or something like that?
I had seen one of those. God, it's probably 10 or 15 years ago. I did not recommend it to any clients because when I'm looking at investments, I'm trying to grow, whereas this specific one guaranteed you wouldn't get money back, but you would get wine. So
I mean, it's interesting just to show you how diverse they all are. It's like really hard to compare all these like alternative investments because one can be just so different from the other. And another example or another category, do kind of alternative investments, do private equities and hedge funds fall under this umbrella as well, or is that kind of its own thing?
No, it definitely falls under here as well. Private equity, investing in private firms. So yes, that definitely would fall in the space. Hedge funds is an interesting one you mentioned, just because there's so many different types and so many things that they invest in, where there's some that will invest only in stock and straight stock. And so depending on the structure, then it may be considered an alternative, but it may not. Other things, just because you had mentioned that wine one, that I found that were pretty out there and extremes examples of things in the alternative space, is I remember years ago seeing things about investing in films. And there was, I think this was back in 2009 or 2010, there was a company that was working with celebrities and they were selling their future earnings. So as an investor, you could pick, they only had 4 or 5 celebrities where you could invest X amount and then you would get X% of their future earnings. Now, once again, these are interesting to hear about and talk about, but I can say no experience in this space. I did sort of track a little bit of what happened to some of these celebrities, and I don't know what the investor would have returned, but I would bet in like 3 or 4 of the cases they would have probably lost a lot of money. But there was one where I think they would have hit a home run and made a bunch of money on it.
Yeah,
so I just don't know how it would work out.
Yeah, that is cool. And there's also another one that I was actually talking about with my colleague yesterday, and he had a pretty funny quote about it. But are either of you familiar with NFT? I believe that's the acronym,
Yes.
NFT. And when I was talking to my colleague about it, I'm like, have you heard of NFT? And can you tell me a little bit about what NFTs are? And I hope you guys have a different opinion about it. But he says investors give big piles of monies to NFT, and they get a big pile of nothing back. And that kind of shocked me. I'm like, what do you mean? That doesn't make any sense. But if Roshan or Eric, if you know a lot about NFTs, I'd love to hear kind of your rebuttal to this.
I don't know a lot about NFTs except that they're sort of the latest wave in the domain of digital assets. So you can, instead of talking about necessarily a digital currency like Bitcoin, you can say, "Hey, I took a snap of myself water skiing, and it was so amazing and artistic that I'm now going to embody that work of art in this NFT and then sell it as a digital asset. It's preserved for the ages."
Yep. And I remember, so the NFTs are similar to what Eric said. I would not claim to be an expert in the space at all. I looked up what the most expensive ones were because I remember about a month or two ago reading about how expensive these were. And then the first thing that came up was a definition, which is non-fungible token. I remember hearing that. But you can buy, from what I understand, you can buy or own a digital moment. So the thing that I remember hearing about with this is that Twitter's CEO Jack Dorsey sold the first tweet ever for $2.9 million. So that was one, and I couldn't name the artist, but I remember a friend of mine telling this story he had seen in the Wall Street Journal, where there was some artist who sold a bunch of NFTs for millions of dollars, and they asked him who his inspiration was and named all these famous artists, and his response was something like, "Oh, I've never heard of them." Right. So it just goes to show you that this is totally digital. The other thing that stands out for me with this, though, is I believe this is run on Ethereum's network. So it's somewhat of a use case for Ethereum. But I haven't heard many people talk about it recently. So I'd be curious to know if they have declined in value, or if maybe I just haven't heard about them much. I feel like there was a month where people were talking about it nonstop back in maybe April,
Well,
and I just haven't heard people talk about it much
so
since.
those I would call more the sort of peripheral and emerging categories of alternative investments, but at least in terms of where the vast majority of wealth that's invested in alternative investments, I think it tends to be in a combination of real estate of various kinds, and
Yeah.
then in businesses through
Yes.
the avenue of middle market business investing. So let's just give a few examples of, or at least categories of real estate, because I think it's easy to miss this. And I think I'll preface this comment about these categories by just observing that in a way, the strategies that we're talking about are at the core of the investment approaches, oftentimes, of some of the biggest endowments in the world. So if you think about Yale Endowment or the Harvard Endowment or some of these, a surprisingly small share of their invested assets are going to be in publicly traded stocks and bonds. Instead, they're going to have, and by the way, this matches up appropriately, I would say, with the duration of the liabilities that they're trying to manage. Right, they're trying to fund things far out in the future, so they can do some things in a different way than, let's say, the average retiree is thinking about. They don't have decades and scores of decades to think about all of this stuff. They have, maybe a 10, 20, 30-year investment horizon. But here's an example. One is just raw land. And so you might buy, if you had a view that a certain metropolitan area was likely to be a fast growing area, and that it would express that fast growth by horizontal expansion, as opposed to necessarily putting up more high rises to accommodate the people and the places to live and the businesses and so forth, then you might think about buying, while it's still pretty inexpensive, low cost real estate on the periphery of this metropolitan area and wait for it to come your way. Another such raw land, or it's actually less raw land, but it's not something that most people have in their portfolios, is forests. And so you can have basically timber land as part of your portfolio. And so many other categories. You guys, what are some of the other categories that come to mind for you as sort of like leading examples?
Well, yeah, when you mentioned real estate, you said raw land and timber. I've definitely seen farmland in real estate, and then even just the more things people more often think about when we talk about real estate investing, from commercial and residential properties structured in a certain alternative deal type space, which could be as simple as a group of people getting together and buying an apartment building, or even as small as buying a house. That would qualify as an alternative investment as well.
In fact, that's interesting you say that. It's I've seen there's an innovative company, I'm not going to mention their name, that has sort of rolled through a variety of commercial real estate investment models as the opportunities in their particular metropolitan area have gradually sequentially unfolded. So once upon a time, which was in the immediate aftermath of the big housing downturn across the country, we're talking about 2006, 7, 8, they were, especially in the aftermath of 2008, they were just buying up right and left single family homes, because now a lot of people who had foreclosed still needed a place to live. They just didn't qualify because of bankruptcies on their credit reports. They couldn't purchase. So they needed a place to rent. So they bought up all these homes and then were renting them out. And that was a phenomenally strong investment model, because they could buy these assets at such a low price through the foreclosure process largely, and then rent them out again and wait until the prices recovered and then sell the base of those assets. Another approach they've taken is to buy infill land. So, as they saw, people were thinking, I don't really want to drive an hour each way, morning and evening to get to, or an hour and a half or what have you. I would like to find a place near, I'm just, being a little bit stereotyping here, but near the Pilates studio, near the Whole Foods market, near the dog grooming shop. So if I can find something that was a little undeveloped piece of land kind of in the center of the core suburbs of these major metropolitan areas, then we can put up an apartment building and we can walk to all of these sorts of things and not have these crazy commutes. So buying infill and then platting it out and then selling it to developers has also been a big success strategy. And I'll just tick off a few more. Multifamily real estate you mentioned, the 3 local dentists or doctors who can buy a 6 flat or something like that. That's one model. But if you get into, let's say, the 150, 200, 250 unit apartment complex that's been allowed to, by its current ownership, to deteriorate, someone can go in, buy that and rehab it and bring it back up to a standard that reflects well on the city and the community, and then raise the rents. And once the cash flow off of those assets has been improved, and then sell that asset to somebody who wants to hold it for the long term again. I mean, the number of warehouses and hotel properties and, the office properties and retail properties, et cetera, it's just like an endless array of categories.
Yeah, it is, Eric. Yeah, and you mentioned, go ahead, Roshan.
No, go ahead, Adrian.
Well, I was just going to mention, you said cash flow is a very big thing about this in the real estate. All these rooms, multifamily properties, cash flow is a very big thing about it. Just, are they able to fill it out? How much money is coming through in and out the doors? And I think that's kind of the compare and contrast, where if you're looking at stocks and companies, it's very big on revenue and profit, and similar in this case, but it's more just cash flow. These income producing properties is a big thing for investors to look into when determining if this alternative investment will be a good fit for their overall plan.
Very true. I wanted to mention one other, Eric, you just lining up with what you said about property investments back in 2000, eight, seven, eight, nine, after things pulled back, I saw a information on a new fund that's just come out. I won't mention it. I haven't researched it yet. I don't know if it's a good idea or not, but I like the overall concept right now, and it lines up with what just happened. What they're trying to do is find opportunities that have come up because of COVID-19. So they're looking at multifamily retail, hotel, office space, student housing, and they're going to look into either debt or equity opportunities. So thinking back to when we had the housing crisis, there was really a big opportunity, not only in the way you mentioned about people having a bankruptcy and not being able to get into a property. Well, in about 2009, banks weren't lending, right? And investors were scared as well. So banks weren't lending, which eliminated a bunch of buyers or investors. Investors were scared, so you're eliminating another group. So now prices just further declined, and there was an opportunity there. So I imagine whether this fund I first heard about is great or not, I don't know yet. I'm going to research it, but there have to be opportunities that have come up because of the
that's a
pandemic.
great point. It is in those. It seems as though I think there's a maxim about real estate investing, which is that whether something is profitable is almost entirely determined at the point of purchase. So if you can buy well, then you're likely that the deal will work out well. And so in moments of enormous disruption and where you have distressed assets of various kinds, you don't want to be too early because the distress might not be over. But a lot of times you can come in. Let me use the example. This is not advocating. This is just commenting about, just because it's in the wake of COVID-19, when pretty much the entire country shut down in early 2020, hotel occupancy rates plummeted. And in many cases were in the teens or even the single digit occupancies. Well, hotels cannot make, that's really a tough business when you have that sort of thing going on. So since most commercial real estate is priced, or I should restate that, valued in close, largely as a result of its net operating income. Then if you have no net operating income, then what happens is that in relative terms, the values of those assets collapse. Now, so what that means is that the then current holders of those assets, yes, harm badly. But people who are in a position to come in with some cash and purchase those assets at a relatively, favorable price now stand, as you've gotten, I think the occupancy rates now, if I'm not mistaken, have recovered up into the 65% area across, many, like the business hotels and so forth. So if that's the case and you see them back on their way up to, the normal long-term levels, I think that's an example of buying in a moment of distress and waiting for things to normalize.
Yeah, I'd actually like to extend what you said at the beginning about in real estate, investing is determined at the point of purchase, what you pay for it. I think it was Benjamin Graham that had a quote that said that for stocks. So I'd almost argue that any investment is the purchase price will be this, maybe the main determinant of the outcome. Although we do see things like AMC running up again, and Redditors can drive up that price also, the meme stocks. The other thing that you had said about real estate, I think we should spend another moment on. When you're buying or selling a residential property, that value is determined by what appraisals or properties selling around you, or really what the buyer will pay, especially in this market where we're seeing a lot locally where buyers are paying over the asking price, which is higher than properties around them and even higher than the appraisal. With commercial property, the value is driven by the rental income directly. So that's what Erik was talking about regarding the net operating income. So if you've got a commercial property, whether it's an office building, an apartment complex, anything like that, where all of a sudden renters are either paying less in rent, or you have a lot of vacancies, so you're just collecting less in overall rent, that price goes down immediately. So the price is directly related to that rental income. And as Erik, as you were saying, that gives an opportunity for cash buyers or even buyers with loans, but just a buyer in general to come in and take advantage of the lower rental rates. And Erik, you can add to this if you'd like, but why you would specify cash versus getting a loan is because the loan is tied off into that income. So if that income theoretically was at zero, it would have to be a cash buyer.
Yeah. Well, listen, guys, we've talked about a bunch of these categories and certain examples. I think it's also probably useful for us to talk about who can do this, who's able to invest in alternatives. And
well, actually, Erik, before you go on to that, do you mind if Adrian touched on this? Can we talk a little bit more about the risks? I don't want people.
Oh, I thought we hadn't really gotten deep into them. Yeah, I was going to talk about risks. I love that topic. I think it's a really important topic. So if you want to go there rather than who can do this, yes, let's do a deep dive on the risks.
Well, yeah, and then we'll go into who and how right after. But the first thing to me that stands out with the risk, or I guess there are two that really stand out that are important. And Adrian, you mentioned both, but one is they're difficult to value, and the other is they're illiquid. So I think we can give brief explanations on that and move on to some of the other risks in there. But the reason they stand out to me, first, illiquid means you can't get your money out. Right?
Wait.
There are limits.
You can't get your money out the moment you want it. Let's put it that way.
Yeah, that's exactly. That's where I was getting at. There are limits, as I was saying. And what I mean by that is, if you were to go out and buy a stock on the stock market today and change your mind tomorrow, you can sell it and get your money back. You cannot do this with alternative investments. Some of them have a schedule with when you can get your money out. Some of them will say, we're going to use this money to buy a building, and when we sell the building, you'll get your money out, and we have no idea when that is. So yes, as you had mentioned, Erik, when you want it, there are various ways to address this with potentially additional liquidity. However, what I mean by that is you might be able to invest in a fund that'll say, hey, you can have liquidity under these certain terms or certain circumstances. Usually when they say that, though, they're allowed to shut off the spigot, so to speak, so you can't get your money out. And I saw a lot of that during the pandemic last year. There were alternative investments in the hotel space, in storage space, apartment buildings, where they didn't know whether they'd be collecting their rents or they'd still have renters and so on. So they just said, hey, nobody can get their money out for now. And a year later, a lot of them still have that stipulation in place. So if you're going to invest in any kind of alternative, be prepared to invest for the entire term of the deal that you're getting involved.
Yeah, so I'll highlight that if it's in a publicly traded structure of some kind, a mutual fund, an ETF, or a variant of a mutual fund known as an interval fund, where there's a liquidity opportunity every quarter, things like this, then honestly, in some private debt and private equity deals, there are stipulations that they, as part of the attraction, they'll say, hey, if you want at a certain point to redeem your investment, you may. And in the first 3 years, it'll come with some penalty, a declining penalty, but you may. So, although those are more rare. So just to your point, I think you need to say, if they're telling me it's a 3 to 5 year investment, I should prepare myself for the possibility that it might wind up being 5 or 7 because of things that they're not wanting to really recognize that are possible risks for them at the business level that might then make it a really inopportune time for them to liquidate the assets that are part of their fund, let's say. And as a result, they're going to wait until there's a more favorable time so that you and they, as the sponsors, can do well with these. In this case, I'm talking more about private equity deals and private debt deals than on the public side.
Well, there are a couple things you touched on that I want to address as well. First, when you mention some of these funds like interval funds or these public mutual fund types that have liquidity, I'm not saying all, but I imagine that most can limit the liquidity just because I've seen those type of funds say to people, "Hey, you can't get your money back," and it hasn't. I've seen it. I've seen it for some of those be only a quarter, and I've seen some of those be for years. So that's where doing your research. We're always giving people homework, but doing your research and looking into what can the fund do to limit liquidity, if they ever do, is an important piece to look at, because I've seen both. Now, the other thing you mentioned that I want to talk about is gaining access through ETFs. And you had said those would have more liquidity. Yes, but with an ETF, it's an exchange traded fund, and there are mutual funds in this space as well, where they'll take your money and invest it in alternative investments. However, you may be losing some of the benefit of the alternative investment then, because it's now publicly traded. You can get in and out of it with liquidity. So you're dealing with another level of supply and demand. So yes, you can access it through that space, but I would argue and I would argue strongly, and I'm sure you'd agree with me, that an ETF fund that invests in multifamily properties, for example, versus getting investing directly in the multifamily, they're really totally different.
They are totally different investments, and the tax advantages for using taxable funds to invest in certain commercial real estate. That we can talk at some point maybe about the tax opportunities that exist there, but for people who just saying, "What are you talking about?" Well, there's depreciation, and then the recovery of that, which is scored against your ordinary income, and then the recovery of that depreciation, which is scored as a long-term capital gain. Since the tax rates on those are differential, there's a tax arbitrage in there that you can't capture in the same way using a publicly traded security like an ETF. So, but yeah, can we talk about some more of these risks? I think the people really should be clear about what some of these risks are.
Yeah, I can dive into another one, but I just wanted to touch on one thing about the illiquidity aspect of it, where most listeners are probably, why would I want to invest something that's not liquid, that I can't trade right away? And it comes to the risk and reward aspect of it. I think that's important, but also the behavioral side of it as well, where say you're in this illiquid asset, this alternative investment, and it's not really doing that well. And let's just say it is liquid, so you want to sell your shares in it and you'll just get out of the position. But then the next year it recoups all of its losses and has an even better year and recovers all your loss. So having that maybe lockup period, not necessarily is always a bad thing, where it can help you where you are locked in this position where you're not making emotional decisions where it comes to stocks and bonds, where I'm in it at this time, it's poor performingly, I want to get out of it. Where this lockup period or this illiquid can kind of make you do your research, do your decision making, and saying, I'm going to lock up a portion of my assets for this period of time. And if it pays off, it's great. If not, I know the risk aspect of it as well. I think is really
I think training you in patience, Adrian, is a byproduct of this, and the allowing something to develop and ripen over time is you're right to point out that there is a plus side to it in many cases too.
Yeah, I recently heard an interview with an investor that said he was comparing investing to the Karate Kid, and how Daniel San's painting the fence, and that's teaching him to block, but he doesn't know it yet. He said the investing equivalent would be having you sit in a chair and stare at a wall for a year. Because if you're a good investor, you don't have to take action, right? You purchase the investment, you do your research, and then you sit there and stare at the wall was his concept. But to add on to what you said about illiquidity, Adrian, if you think about it from a common sense perspective, if you invest in an apartment building, right, and let's say you invest with 100 other people, so you own 99, so you own 1% of this building. If you say you want your money back, they can't sell this building just to give you your money back. So we've been talking about illiquidity as a function of this investment and as an additional risk. I'm not saying it's not that, but if you think about it, it just makes sense. A mutual fund can liquidate stock to give you your money back if you want your money back. But you can't sell a building because one of the 1,000 or 100 shareholders wants their money back. It just can't be done practically.
So a way of mitigating this particular illiquidity risk is don't overweight any single investment that you undertake this way, and don't overweight your portfolio with illiquid things. I mean, some people say, "Hey, I want to retain liquidity. And I say, I understand that. But if 80% of your portfolio is liquid and 20% of it is not, and I'm not saying that's not a prescription for how much of your portfolio should be illiquid. Listeners, please understand. I'm just using that as an example. In this case, I think it's reasonable to ask, well, let me ask you this. Would you be ever intending to actually liquidate 100% of your portfolio all in one fell swoop and spend it and have it be gone? Probably not, right? So you're probably thinking in terms of your portfolio has a 10, 20, 30 year horizon of things to fund. You believe me, you'll have time in there for the illiquid things to become, for the outcome, good, bad, or in between, to be realized in the final analysis. So, but I've got more risks than just illiquidity and difficult to value, guys. Can I go through some of these others?
Yeah. Agreed. Although I don't think we talked about the difficult to value one, so let's just give that a quick explanation and move on to it. So just using the example I used a moment ago for an apartment building. Well, with difficult to value, and I don't know if difficult's the best word, but with the stock, you get a quote every second, right? You literally hit refresh on your phone and you'll see another number possibly show up if you just keep hitting refresh constantly. With these alternative investments, if it's something like a building, you can get an appraisal done, or you can look at the rental income, and they usually do that on an annual basis. But then if your alternative investment is private equity, and we talked about investing in a private business, you're going to have to go get an accounting firm to come in and do a business valuation, and sometimes you'll get a range of values and answers. I've seen pretty big ranges before. So with difficult to value, it just means that I think it underscores having that time frame, because one, you're not going to get up to date prices every single minute, but you could very easily get a lower value than you thought one year, and it totally changes the next year. I saw this happen a few years ago where a company owned a bunch of healthcare facilities, and their biggest tenant filed for bankruptcy. So now and that just happened to be during the time they were getting their annual valuation. So they dropped by like 30 or 40%. And the following year, they fully recovered because they just didn't have time to re-rent it when they were doing that valuation. So unless you have anything else to add to explain difficult to value, Erik, we can go on to the next one you've got.
Sure. So I would say another one is the market environment. So, let's say you invested in retail, and that then suddenly the tipping point occurred where suddenly you saw announcements by one major retailer after the next. We're closing all of our stores. We're going entirely online, or we're closing all of our stores except our discount outlet stores, or things of this kind. And you were invested in in retail. You suddenly saw a massive disruption in those properties. And so the market environment, in ways that you can't anticipate necessarily, or maybe you could say, no, that was one you could anticipate, but leaving that particular example aside, recognizing that sometimes the market can have a big disruption, like a COVID, which seems to come out of just nowhere, and suddenly hospitality is crushed under all of that. Office was crushed under all of that. You just have to be prepared that certain things can happen, and coupled with the illiquidity issue, it may take a while for your stuff to come back. Another thing I would say is I think it's really important in these more concentrated investments to look closely at the track record of the management teams that are there, because I'm not trying to accuse anybody of anything, but sometimes the promises are big, the ability to execute just isn't there. And in some cases, although they're rarer, the promises are big, but there's, if not misfeasance, I would say borderline malfeasance, where I would say it seems as though the deal underneath the hood was structured in such a way to enormously benefit the leadership team and the sponsors. Particularly, the red flag for me is lots of incentive fees to keep managing assets where, so the promise of a 3 to 5 year exit or something along those lines is really undone by the 1 or 2% per year that the management team is collecting they don't want to part with that gravy train a lot of times. And so you just have to understand whether this team has a track record of being able to exit with previous deals and do so in a timely way, as well as manage these investments they've made to profitability so that they can indeed be sold.
Well, hold on, Eric, I got to stop you there. You mentioned this. We didn't mention this category, but cryptocurrencies or crypto assets. We did talk about NFTs, but that's another alternative. And I recently, literally Sunday, started a podcast that I just kept going through every episode and finished. I'll mention it. It's called Exit Scam, but the whole concept of this podcast is it was at one point the biggest crypto exchange. It may have just been the biggest Bitcoin exchange, but Bitcoin or crypto exchange in Canada called Quadriga. And the whole podcast, the CEO dies, and they say they can't locate the money because he ran it all and he's the only one that had the password. So all the people that put their money in this. So the whole concept of the podcast is, did he actually die, or is he secretly living someplace else and he stole all this money? So it just fit in well with your description of looking into management. I don't want to give away too much of the podcast because I did like it, but they talk about looking into management, and that's just another example that is pretty timely with me just listening to this thing. It's not over yet. There are a few episodes left, and I will be listening to them as they're released.
That is really interesting. Well, you'd think a death certificate could solve that, possibly, or a body.
They have both, but there's a little bit. Once again, I don't want to give it away because I think it's worth listening to. But you would think that, but there's more to it than just that.
I want to just talk about one other aspect that's a risk, but I would say maybe risk isn't the right word. Maybe just understanding the nature of the deal and being a little bit more careful about which deals you're willing to approach. And that is just looking at the internal division of rewards. So a lot of times, now I'm talking about private equity and private debt, both on the real estate side and middle market investments. And these kinds of funds are sometimes structured in such a way that there is a layer of upfront money from your investment that's distributed right away. And oftentimes that is 10, 12, 13% of the original investment. So you thought you put in, and I'm just making up the numbers. This is not the recommended allocation into one of these. It just makes the numbers easier. You thought you put in $100,000. But in reality, oftentimes, if you're working with a commissioned broker, they took 6 or 7. Their firm took 1. A group called the managing broker dealer took maybe 2 or 3. The wholesaler who got it out there took 1. And there's many hands that are saying, let's get paid up front. And so what you might have is that you put in $100,000, you might have only 87, 88, 89 actually working for you at the get-go. And so now, while they're telling you, yeah, we're going to get your money back and you're going to make these yields on it and everything, they're fighting and clawing just to get back to break even on that investment. And hence, it has to be a pretty solid. So the better you can do at reducing or finding investments that have a thinner layer of those initial distributions, probably the better off you're going to be. And by the way, I'll just mention, and this is, I guess it's partly an ad. It's an explanation, is that since, I think about this as a fiduciary, then that means that at least when we're doing alternatives with clients here in my office, we're not charging a commission. So we strip the commission off of and so in using the example that I just gave, you would have put in $94,000 with your investment value immediately being repriced at $100,000. Although behind the scenes, back there, really only 87, 88, 89, 90 is working for you. But that's all to have put in 94 and to have 87 to 90,000 working for you, as opposed to put in 100 and only have 87 to 90 working for you, I think means that you have a better possibility of seeing that actually return a fruitful outcome for you.
Yeah, Eric, you make a great point, though. Even eliminating that commission, there are still other fees, right? So you improve it by putting the odds in your favors, but that also varies by type of alternative. We mentioned how vast they can be. Not all alternatives have those kind of fees, but some of them do. So you've got to look at it. I remember years ago for there are real estate investment trusts that have that, and they would use the term how much money is going in the ground, right, versus how much.
And is your experience also that it's usually in that $87 to $90 per 100?
Oh yeah, I've definitely seen. I've seen more in the 88 range than I have in the 90
I would
range.
agree. Yeah, more like 88. Yeah.
Yeah. Yeah. So yeah, definitely agree with that. With the alternatives, and we talk about risks, the other thing I think we have to mention, you mentioned fiduciary as well, but a lot of these are not regulated as well. So some of these are will register with the SEC, and they'll file special registration types to say, hey, we're registering, but we're not regulated. We're not regulated by you. There are others that depending if they do something in specific local markets, most frequently I'll see it, they won't register at all, right? They'll be able to exempt based on how much they're raising and so on. We deal with most of the things that have to register, but a lot of them will register in name, but aren't fully regulated by any governing body as well. So you've got to look at that a little bit further. Not that there's anything wrong with it. It's just an additional risk because they don't have to follow those same rules.
So I think it's probably useful to help people think about what to expect, because I think for the most part, while we've been explaining what they are and we've talked about a lot of the risks, I don't know that we've necessarily laid the groundwork for understanding what to expect when you do it, except that you might be tied up for a long time. Can we talk about further some expectations with this?
Yeah, I'm going to let you start just because when I think of that question, there are so many different types of alternatives that are out there. And maybe this is the answer. There are different types of alternative investments that are out there. So your expectation should vary based on the
Fair
type.
enough.
So just to give a basic two examples, when we were talking about liquidity earlier, and I mentioned, well, if you own 1/100th of an apartment building, can't expect them to sell that 1/100th to give you your money back. That's when we're looking at real estate. But then if you compare it to, you'd mentioned, I believe you or Adrian had mentioned a hedge fund earlier. Well, if the hedge fund you're in is in publicly traded investments, they might be able to just give you your money back, right? That's where that might be an expectation. Or another example I've seen in real life is investing in debt. If you're investing in debt in non-public companies, so it's private debt, you may not be able to get access to your money. On the flip side, there are types of private debt where you can potentially get more access to your money. So they're even within the same category, and looking at just that one aspect of risk of illiquidity.
Yeah, so I think that's a really good point.
Could be very
I would make the broad distinctions as follows. One is between those things that are embodied in publicly traded securities, where your expectation is if you don't like the way that it's behaving, you have the opportunity to exit. But I would think a lot of times these alternatives are you're investing in assets that for the deliberate reason that you're looking for some things that don't behave the way everything else in your portfolio behaves. And so if you see something falling in value while the stock portion of your portfolio is rising in value, that's not necessarily an indictment of that particular alternative investment. It might be that's precisely the way that it works. And then because oftentimes, let's say when it goes the opposite direction and then the stock market is falling, that alternative actually might be rising or maintaining value. So you have to ask, what is the purpose of it within your portfolio? But if we're talking about on the private side, then I would make the further distinction between debt, equity, and debt, equity disguised as debt. Let me explain the middle one, just the last one, I guess, just equity disguised as debt. So there are many layers in, let's say, when purchasing an office tower or purchasing a business. There are many layers, oftentimes, of different capital infusions. Banks, for example, as creditors, usually occupy the premier point in the entire stack of these different, what we call the capital structure, because they're the first to be repaid. And then would be bondholders, then would be what are known as oftentimes mezzanine debt holders, and then lastly, the equity holders. The mezzanine debt is often pitched as a debt instrument, but in fact, it is serving as a replacement for some of the equity from the sponsor. And so while it stands a little bit in front of the equity, it's not up, it doesn't have equal treatment with the bonds and certainly not with the lenders, the banks that are lending. So it's just, I say that just quickly because if you do use a mezzanine debt offering, you shouldn't assume that necessarily, hey, it's debt, I'm of course going to be repaid. You might not be fully repaid if things go bad. But on the debt and equity side, I would say if you're dealing with some sort of bond structure, more often than not, what your expectation should be is that you'll put your capital in, you'll get your interest payment, and then assuming that things don't go awry, you'll get your capital back. But on the equity side, particularly if you're seeing annual valuations, you might be disturbed the first year or two to see the first year or two or even 3 year valuations on that deal coming back. You might say, wait a second, I put in $100,000 and it was scored at the time. It was scored at the time at $10 a unit. So I bought 10,000 units at $10 a unit. Now it's what's going on here? It's being scored at $6.50 or $7. What happened? Well, that phenomenon might be that they're just really terrible at what they do, or that the market impacts that we were talking about before came in and walloped them. But it also might be that what you're seeing is the impact of something that we typically call the J curve, which means essentially that in the early going of these private investments, particularly if they're business investments, which take you're not just taking over a mature cash flowing business or a mature cash flowing property. There's something you have to have a period of investment before you get the business that's cash flowing, or before you see the cash flows from the property, et cetera. During that period, you're putting maybe money in the ground to, dig holes, or, contract with architects and engineers, or whatever the case might be. So money's going out the door before there's anything tangible that's available to value. And as a result, you just have to wait it out and wait till it kind of settles down, and then it starts to come back and grows further. Comments about that?
Great point with the J curve effect. I think an example that makes it easy to think about is if you're doing in that real estate space something where there's new construction required, right? Let's just say you're building an apartment building or a hotel.
Right.
Well, your money goes in today. If you're building it, there's nothing generating income from day one. So you're going to keep spending money until the hotel or apartment building's built. So your value's going down, because there's less money in the bank. There's nothing really that you can value until it's, maybe various stages of construction, but till it's done. And then we mentioned how these commercial type deals, the value is based on the rent coming in. So even the moment the hotel is completed, or let's call it the apartment building in this case, let's say the moment it's completed, that happens to be the date of your annual valuation, you still might be below your initial investment because it's got no cash flow. And then it's fully rented a year later, and you'll see, it actually worked, and you've gone up in value. So I think that's an easy way to understand that concept. I just want to move us over to a final topic for today within the alternative space, and that is if I'm an investor and I decide I'm interested in this and I want to see what's out there, how to use it in my portfolio and so on, how can this fit in? Can you just name a couple sources or places you can think of to look at? I think the obvious would be you could reach out to one of us, and we'd be happy to share information with you and tell you what we've got available. But where else can I find potential alternative investments?
Well, let me
just learn a little bit more about this to see
further elaborate on that one point. So we don't talk a lot about our firm, and because we're trying to mostly be, an educational enterprise here with this podcast. But it is the case that one of the aspects of our firm that I do appreciate is that to a much greater extent than what other firms of sort of serving a similar client base, that our firm has gone to great lengths to identify and vet, I think at any given time, maybe 40 different, rounding it, 40 different alternative investment options. So I think as a result, if you can find a firm that has that sort of strength and history and specialization, then I think that's a place to start. Although, again, I would encourage you to find someone who is going to behave as a fiduciary with you in the consideration of that. But I would also say there's one industry conference that's highly regarded is a conference called ADISA. Alternative. I can't remember exactly what the acronym ADISA, ADISA stands for, but anyone's welcome to register and attend. Another group that has an extremely high or strong reputation in the area of reviewing proposed alternatives and then rendering its judgments about it is a group called MIC, M-I-C-K, MIC Law. So if you can get the stamp of approval from MIC Law, that's oftentimes a very good sign. And those are, I'm just mentioning a couple of categories. So there's many other ratings organizations out there that will do reviews of these ideas, but it's not like there's nothing out there. If you just dig a little bit, you'll be able to find some of them.
Yeah, and I going back to what we briefly touched on, if you do a Google search, you will find alternatives, and you'll also find some of those publicly traded alternative investment options that we mentioned. I just want to make the note once again that they can act very different. So this is a starting point to look and see what fits you, if at all. Right? There's nothing wrong with not investing in the alternative space either. I've definitely worked with people who I by policy won't invest in anything like this, and I also have met people and worked with people who put all their money in individual properties. That would be defined as an alternative, and that was their retirement plan to get rental income from all these properties. So it really comes down to you as the individual, what you like and what you're looking for. But I think that probably going back to behavioral finance, I think answering that question,
right. I think we also should mention
might
that
help you figure out which path to go in the alternative
alternatives are available to every investor. So there's a certain tier of investments of this kind that are reserved for people who are known as qualified purchasers. Those are folks that have at least $5 million of investable assets, and so the nature of those investments tends to be minimums that are pretty high, $250,000 to $500,000 sometimes. There's another tier which is reserved for people who are at the accredited investor level or higher. That in that case, the federal definition of that is that you have $1 million of net worth, not including your primary residence. So it could include a second residence, it could include commercial real estate, it could include your 401k, but in other words, leaving out your primary residence, if you're at the $1 million level or higher, then there's a tier there for you. And then there are other investments in which anyone that typically would have at least $70,000 of income or $250,000 of investments can invest in. And then there's still more that there's no restriction whatsoever. So you just sometimes you have to ask, hey, is this one reserved for example, accredited investors or not? And then if the answer is not, and you're not an accredited investor, then it's something that you can take into consideration as a possible avenue for investing.
I agree. We
All
have
right.
provided a lot of information and gone over our allotted time as usual. For listeners that hear us say this on occasion, our goal is normally to be around 40, 45 minutes, and we tend to go way over. And we've discussed coming back to this topic to give you some additional information. So we will be revisiting the alternative
nothing to
investment
add.
space in the future. Gentlemen, anything to add in closing? All right.
Yeah, it's been another informative one. I really enjoyed this one.
Excellent. We're here to help. We hope you found this useful today to hear about. As we mentioned, we are happy to answer questions about anything really, but the alternative investments being the topic of the day, we're happy to answer any questions on that. Please like, subscribe, share with your friends and family. Give us 5 stars. And we look forward to speaking to you again next week. This has been another episode of the Retirement Lifestyle Show.